You look amazing.
I am at my target weight. When I was a year ago,
Wegovy.
Yeah.
You don't have that Ozempic face that people say.
No one does.
No one
That's total
does.
bullshit. That's the New York Post. For whatever reason, they have something up their ass about this thing. And once a week, they post some like horrible story out of millions of people that are doing this. And it's improving their lives metabolically, like a whole host of things. You know what I mean? In all these ways. And they just want to post the one thing.
I'll take Ozempic face over what I have now, which is Nabisco face. Like, what?
But how's your muscle mass?
It's awesome. I've been working out. I sleep better.
Let me see. Make a bot.
I don't snore anymore. So I wake up and I have
Josh snores like an animal.
I wake up and I work out. Listen, like any weight loss regime, if you are on a heavy diet, okay, you will lose muscle mass. Okay, so if that's the biggest gripe, you got to work out. Like that's the whole thing. And so then the drug acts as a bit of a jetpack to the whole thing. And that's my friend Zach, who's the CEO of Roman. And that's what I do this Row Body through. They prescribe the medicine. They manage the whole process. It's nutrition. It's exercise.
Did you have to take that stupid mail order drug test that people?
Yeah. But why is that stupid? Do you like going to the doctor and giving blood? So this thing took 25 minutes.
How are you friends with somebody like famous people? What's your story?
Me? I don't know. Josh is the most famous person I know. CRB. And I heard
who are these famous people he's friends with? The CEO of Roman?
He's a stud.
Is it Roman Reigns?
I won't
Who's
say
the
it.
CEO? Who's the CEO of Roman? Is it a famous person?
No, he will be.
But like the Celtics dude.
Oh, Wick Grosbeck?
How do you know that guy?
Oh, he's a great dude. Good friend of mine, Rick Heitzman, who runs First Mark Capital here in New York. And he is actually an investor in Row, early investor. He's on the board. Wick is also an investor there. That's how I know those. You just connected the dots there. Pretty good. Wick actually has a television show that John Cryer is going to be the lead in. It's called Extended Family.
I just saw the preview for that.
And it's and Wick and his wife, Amelia.
Is this John Wick? Who are we talking about?
Wick Grosbeck. So he's the lead owner of the Celtics, and he wrote this with his wife and a team of writers. It's about their lives because Amelia's his second wife, and it's talking about the relationship between these two extended families.
It's a good premise because that's something that has always worked on television.
Yeah.
Like, go back to Brady Bunch.
And you know who else has always worked? John Cryer.
John Cryer.
I love that guy.
Yeah.
Right?
Well, what else was he in besides 2.5 Men? I don't really know.
He was in this movie in the 80s.
I know the movie.
Yeah. Remember that? It was excellent.
What was that called? Something Away or... It's like a 2-word thing.
Yeah,
Hiding Out.
How about Hot Shots?
Oh, when the kid goes to high school to get away from like a crazy drug dealer or something like that.
He's like dressed up like a high schooler.
Yeah. Well, he's the nerd friend, I think, John Cryer.
He's the guy in Hot Shots with like the glasses, or he can't see. He's got like this weird vision thing.
He's John Cryer. He's a legend, an 80s legend. And you know what the good thing for you, Josh, is that is like, think about all these people who've been recycled with Stranger Things. You had, you were a legend in the aughts. And you're 20 years from now, it'll all come back. You'll be retro.
I love that they brought Winona Ryder back.
She's great. But think about all those guys. Sean Astin, remember from Rudy? All those
Lord of the Rings.
Yeah.
Very cool. Yeah. Well, they'll bring me back someday. All right, let's get the show on the road. What do you think?
So I can't hear you.
I don't know I don't even know if you people know that this is the final show of the year.
But wait, are we really regular? Because I barely hear you guys.
Shut. Yes, you do.
No, I don't.
Turn him up. He wants to hear us louder.
More.
There it is.
All right.
Regulators, mount up.
Hey, what show is this, John?
This is Compound and Friends episode 123.
Today's episode of The Compound and Friends is brought to you by Public.com and the Public app. I love this special offer that Public is doing for the holidays. They have this great bonus thing where if you switch your portfolio to Public from a different brokerage firm, you're going to get something, and I'll explain. Everyone will get a unique offer based on the portfolio that they're moving, and it takes less than a minute, literally less than a minute. All you have to do is enter a few details at Public, and they will send you a personalized offer. On average, their offers are more than double what the other firms are paying. 85% of people who apply will get an offer of at least $100. Unlike most of the other brokerages out there, Public's offers are uncapped, and the highest offer for switching they've given so far is $19,000. Maybe you could beat that, maybe not. Pretty good. Check it out and see what your offer is with no obligation. I want you to go to public.com/switch. The average offer is $396. Most people get at least 2% of their portfolio value as a bonus. You can boost your offer if you also want to transfer cash directly from your bank account. Once again, public.com/switch. This is a paid endorsement for public.com. Terms and conditions apply to the transfer offer. Brokerage services for U.S. listed, registered securities, options, and bonds in a self-directed account are offered by Open to the Public Investing Incorporated, member FINRA and SIPC. Additional disclosures and the link to transfer terms and conditions can be seen in the episode description. Episode 123. Guys, this is the last show of the year, and I have to tell you, we could not have brought in a more fitting, appropriate guest. Dan is the principal of Risk Reversal Advisors. You know him as the co-host of On the Tape podcast, founder of On the Tape, you and Guy and Danny.
And Danny Moses.
All right. I think a big chunk of our audience listens to On the Tape. You also have the OK Computer podcast, and Packy's on that, right?
Packy comes on that.
I haven't seen Packy all year. We got to get Packy on here. How's he doing?
He's doing great.
Yeah.
I mean, he was heads down during crypto winter.
Yeah, he had no choice. That's the life.
Can I give a shout to Packy? He just wrote, I've spent many hours reading his blogs, his essays, and the one that he wrote this week about losing momentum and getting it back is great.
Well, and he launched a new video series, Age of Miracles. So that's one of the things we talked about. He's just a really curious guy. He's a really smart guy. He's not condescending. You know how many blog posts, and this is one of the reasons I think you guys both had such tremendous success, demystifying difficult topics in a non-condescending fashion. You know what I mean? And I think he does that.
He's a gem.
Yeah, he's lovable, and we gotta get him back here. And you are a panelist on CNBC's Fast Money. That's how you and I met for the first time. How long have you been on?
What year was that?
When did you start?
I started doing options action in April of 2009. I started doing
God.
Fast Money regularly in 2011.
How'd they find you? How'd you find them?
You know, it's crazy. It was 2008. I was at Merrill Lynch. I was trading a prop book in the equity derivatives group. Obviously, at the end of 2008, they were not going to be trading prop anymore as we headed into 2009 in the merger with Bank of America. Well, it's for another pod.
Something about the balance sheet, et cetera, et cetera.
I literally had a headhunter call me.
Are you saying you caused the crisis?
Well, actually, in Q4 of 2008, that equity derivatives group made $1 billion. John Thain, who was the then CEO, called it out on their conference call, earnings call, basically saying thank you for that. And my friend James,
we needed that $1 billion.
Yes, well,
that offset the $80 billion they lost.
Journal it over to Bank of America, please. No, so it was basically a headhunter. They were trying to place folks like us at hedge funds that equity derivatives options were just blowing up at the time, right?
Yeah.
And in a good way, and so lots of funds. If you go and trace back a lot of these multi-strat funds that have these big vol strategies, it really goes back to that period because there's a lot of really smart people, quants, but also just really focused on vol directionally, and they lifted them out of there and started. You
were trading the bank's money, or you were working with clients, or both?
I had no client contact whatsoever, so I was off in a corner. It was great. I mean, listen, I grew up on the buy side, so like the idea, like I always dealt with all these major, sell side banks. I just was not in the business of sales. I didn't know anything about it. So for me, it was really interesting to be inside of that operation for 2007 when things couldn't have been better, right? Think about how quickly things changed to 2008 and how quickly they went bad. And none of us ever thought a bank of that size could go away, right? And it did that.
Did they buy Countrywide?
Yeah.
They did, right?
Yeah.
Oh my God.
And I think the summer of 2007, they bought. That's
so funny. Dude, that was so funny.
But how'd you get to CNBC? Finish that story.
So a headhunter who was trying to put me in front of some hedge funds at the time said, this is kind of a weird one. CNBC is looking to cast a show of options traders who can walk, talk, and chew gum at the same time, and I think you might fit that bill. So I went into a screen test.
So
at
what, he had a
CNBC.
list and you were just on the list?
Yeah,
Or he thought of you because you knew him?
He thought of me because I probably had gone and interviewed at a couple of hedge funds. You know what I mean? And then at that time, fund performance was horrible. So like no one was hiring to do anything, you know? And I was actually just going to go on the beach. I'd only been there for a couple years. Think about this. I worked with so many guys at Merrill who'd spent their whole careers there. So let's say a half of their comp for the last 10 years was in that stock. Part of the culture was you never sold that stock.
Oh, MER, Merrill Lynch stock.
MER, yeah. So it was actually a really sad thing to see. And I'll tell you this from my experience on the buy side in dealing with Merrill, they were always one of the best firms ever to deal with. They were just solid citizens, good people. They did care about, you and your business and all that sort of stuff. So it was actually a really sad kind of.
Oh, I agree. And I still don't understand why they continue to downplay the Merrill insignia. The logo is gone. They ripped the name off everything.
Be bullish.
It was like one of the greatest Wall Street brand names, other than in that 2-year period. But for 70 years, that was an amazing brand. And they just it's like it never existed. I almost want to buy that brand. And bring it back.
Didn't someone buy E.F. Hutton recently?
Yeah. Somebody bought E.F. Hutton. Somebody bought Robbie Stevens.
Robbie Stevens was a
mark
great
my words,
firm
Lehman,
in the 90s.
The Lehman name will make a comeback in some way, shape, or form. Because these names, if you can get past that 2-year stretch, they have equity. There's a
here's a better
another
question.
life for them.
Here's a better question.
They have negative equity.
Is there a boutique that exists today
Yeah.
that has the potential to get to a first tier sort of firm investment bank as we think about it? Because we haven't seen one of those bubble up and become
They don't
that.
want to. The good ones don't, like Allen,
you don't think-
Allen and Company.
You don't
they
think
don't want
Bullish
that.
would want to be like a Jeffries or
Here's what I
something
think.
like that?
I think the next Merrill Lynch, it's an RIA called Rockefeller. I think it's Rockefeller
Yeah, they're
Partners.
doing a big roll up. Is that right?
They're like, all right, how much do we have to give you to come over? 300% of your trailing, whatever. We'll just do that. Advisors are signing on there because they know what they're doing in terms of tech. And they're giving you that wirehouse experience, but with a way better payout. And it's kind of cool to call your clients and say, I'm joining the Rockefeller family office. Either your client, if your older clients think it's related to the real Rockefellers, your younger clients think it's Jay-Z. Either way, it's really good optics to say that you just got recruited by Rockefeller.
So that's one part of the business. But let
They're
me
going to
ask you
get
this.
big, though.
What about
They're gonna get
what
big.
under James Gorman, what Morgan Stanley did? They bought Eaton Vance. They bought E-Trade. They bought a lot
Those
of
are
other
lead
sorts of
sources for wealth management. It was really smart. The other thing that you're going to see happen, though, is you're going to see the bulge brackets or the wirehouses, whatever you want to call them. Those wealth management operations are all going to become multi-tier. And Wells Fargo is a great example. Rather than lose all of their best people to opening their own firms and completely severing ties, Wells Fargo built a playground where they could pretend to be entrepreneurs. They could run their own business, but it's on Wells's platform. And that's in response to the Wells Fargo name having been somewhat tarnished over the last few years, 7 or 8 scandals in a row. So it's just look, we can support these advisors. We don't want them to leave and go join Dynasty or Hightower. So let's keep them in-house, but we'll give them a little bit of fake freedom so that, they can tell people, oh, my firm is, Mountain River or whatever, whatever the So that's the big trends going on, I think. And those firms will get bigger.
But there's a benefit to that too. To being attached to a large money center bank, you can actually give them, better rates on mortgages. There's when the IPO calendar comes. I mean, there's a whole host
if you
of
have
things
clients that have if you have clients that have $100 million, they want the services of those banks. Like UBS, Wells Fargo, it's meaningful. They don't need everything the banks do. But if you're an advisor to that category, it's scary.
In the next 10 years,
leave.
RAs will be able to offer all of those banking services.
Well, so that's the other side of the coin is Schwab is leveling up what they're
Everybody is.
enabling us to do.
Don't you want to buy the picks and shovels who are helping them do that?
No, it's a low margin business.
Really?
Dan, go like this. You've got some fuzz in that beautiful head of hair.
They call it a fly.
It's from the
Oh, it's
Santa
from the
hat.
Santa hat.
No, it's from the Santa hat. It's not your
You have
fault.
so much hair, it can't come out.
Nicole
You made me wear this.
Nicole, bring him a brush.
Okay.
All right, we're starting over. All right.
All right. This
The
is
whole
the first
thing.
You go first.
All right, so
it's a good question.
So, Dan, your handle on Twitter is Risk Reversal. It's the name
risk
of
reversal.
it's the name of your company.
Yeah.
So I saw this chart from Bloomberg. Dollar risk reversal is least bullish in over 3 years. So for the audience, what in the hell is a risk reversal?
So risk reversal it's in derivatives, it's in futures, it's basically doubling up on something. If the call gives you the right, let's say, to own something at a particular point in time at a specific price, and a put gives you that same right to sell something. So think about it this: if you're doubling up on that, if I was really bullish on something, I might sell a put, which is actually bullish, and buy a call. That's a bullish risk reversal. Collar.
What makes that a bullish risk? What makes that a bullish?
Because if you're selling the put,
why is it called that?
It's basically, I mean, it's just technical jargon. You know what I mean? Like you know how we come up with names for all this sort of stuff. And so like the specific question that you're asking is basically talking about the skew. And I don't want to get into like weird things, but like the price that it costs to buy a put. And the price that it costs to buy a call at the equal distance away from the actual strike. Or
one will be overvalued, the other will be undervalued.
And usually that's the case. And that's what that's saying, is that it's really cheap right now. And I've noticed this. You see this all the time in periods like we are in right now. Normally, okay, there would be greater demand for puts, right? The higher something goes, right? Like the more you want to protect it. So therefore, option dealers know that, right? And they're going to price it up. Right now, even as the market is going higher, the stock market, okay, the everything rally. Did you name that? Who named that? You know, there's greater demand.
Somebody bearish.
There's greater demand for calls right now. So the skew is towards calls, which tells you
that
something
could flip
about
so fast.
And it can. Well, it flipped yesterday, right? So we're recording this Thursday afternoon. We saw what happened.
In which market? Oh, you mean the S&P?
Yeah. But so it's a great, like you guys have probably been talking about the RSI has not been, the relative strength index has not been, you know, this skewed, you know what I mean? Towards.
Can we talk about that?
Yeah.
A reporter asked me why the market went down intraday.
He called me too.
700 Dow points. And I said, oh, it's options gamma. And I don't even know what that is. I just had to go. Like, I didn't want to like get into a whole thing. Yeah. So do you think that there is an options related reason for a 3 o'clock sell-off that catches everyone? Now, it doesn't really matter because the market's bouncing back today, but like, what is that about?
We just named our pod. I just did it with Danny and Guy. We named our pod. You guys can't use this Brokeback Market, okay? Because they can't quit them.
Duncan,
right?
Would we ever use that? Wait, because what?
Because they can't quit them, okay? So think about that. Like,
I don't get the reference.
I just can't quit you. Oh, obviously not a big Brokeback guy.
All right.
I'll explain it to you later, okay?
Right.
Got it.
So, and then also a song. Guy's mind immediately went to Led Zeppelin on their inaugural album. I Can't
Guy's
Quit You,
mind
Baby.
goes to Led Zeppelin.
Okay, obviously. Okay. So the point is like we had that sell-off. It felt real, right? Because like some of the biggest market leaders got hit. Everything got hit across the board. You know, it was the first big down day in a while. And here we are. You wake up and they're just bid up. You know what I mean? And they kept it going.
But what does something trigger that? That's rebalance or options related, or
So
I don't have a good
You were
answer.
right on the gamma, and we're not going to get into the specifics of it. But what happens is this, okay? They're 0 days to expiration options. They literally expire at the end of the day. They expire to cash. You don't have to exercise them, okay? Like so, they can. There's different expirations. So if all of a sudden at 2:30 somebody bought the at the money puts that expire in an hour and a half, and they bought a lot of them, okay? And they might have bought a lot of other ones and some other names. Some of the details that I saw. There's a great Baycrest report out about this. I'll send it to you guys. You can put it in your show notes, okay? And it was talking about this behavior happening late in the day, heightened complacency. The VIX was at 12.5. You know what I mean? Think about that, right? And like everything's the dollar's down. All the stuff that we think about that are like, you know what I mean? Like risk on was happening.
Conditions for
and so
bulls.
you can use a tiny amount of notional value. You get a couple dealers who sell those options to you off sides. They scramble to hedge. They might do it in other expirations, okay, with in the SPY. This was in the SPY. They may hedge with futures, and that might cause a chain reaction of other things, especially in a low volume.
Do you think it's intentional?
Oh, yeah. Oh, somebody
wanted to create volatility and profit off of it
This is coming
in the
to
last
a
hour.
theater near you next year, and I'm going to tell you why. There are going to be all these funds, these quant funds, they're going to be probing these sorts of, they look for inefficiencies, right? It has nothing to do with fundamentals. It has to do with market structure. It has to do with where the retail is obsessed with. Like
I agree.
I know a kid in California. He's a senior. He's going to college next year, okay? He wakes up really early to trade 0 days to expiration options. Think about that. He's 18 years old. It's the new trading NFTs or shitcoins or this and that or whatever. So all those things come to an end. I mean, we know that, right? Meme stocks, all this sort of stuff. So something's going to happen next year. There's going to be some sort of
like a Volmageddon type thing?
Yeah. I mean, listen, and you know, like no one complains. Guy just said this on the pod, and I think it's a great point. No one complains on the way up when all of this is adding like an underlying bid to the market.
Do we think that that's what's happening? Do we think that that's what's happening also at the same time? Is that the grind higher over the last 2 months or so is being aided and abetted by options activity?
Well, I think some of this, if you look at some of the most actively traded options on any given day, they're options that expired at the end of the day, but they're also a lot of very short dated. So if you're looking at it in the indices or if you're looking at sector, like sector options, it is vol suppressing, right? So a lot of folks, would say, it doesn't have to be that way. People are always buying options, but if the market's going higher, complacency is rising, right? And there's not a lot of demand for downside, then if everyone gets to one side of the boat, it does have the potential to get things haywire. And now we have the ability to just go and hedge with futures in a really easy way. Retail has those sorts of abilities. So if a lot of people have lots of different options in which to speculate, but also hedge, and everyone runs for the door at the same time, that's the only reason why.
Stupid question, because I don't know any better. 43% of daily options trading is in zero date. Does that sound right?
Yeah. Well,
okay.
It could be. Yeah.
I think that's the case right now, and that's really, really elevated. It's tough for something that expires in an hour to create a lasting phenomenon on the market. If there is some sort of incident, then the next day people just don't put those trades in to the same extent. And then on the third day, it's like it never happened.
No, that's smart, except for the fact that go back and remember what it feels like. We've just had 8 consecutive weeks of the market going higher. We've had 10 of the last 11 days where the stock market went higher. There's periods where it goes the other way too, right? And sometimes it's hard to remember that when you're in the throes of the sort of, market environment, the sort of sentiment that we have right now. And I think what's interesting to me is that this market in 2023, and I think you guys would agree, has climbed a wall of worry. You're
Twice.
Right?
Correct. 2 of them.
Yeah. And, but there's still a lot of underlying sort of things that should make, folks a little worried because I think we're getting to a point right now at the end of this year where visibility is not particularly great. You know what I mean? As it relates to companies and the guidance that they're giving. I don't think the Fed has
a lot better than it was.
Is it worse than usual?
No, but if I look at the market in 2022 versus 2023, if I look at the economy in 2022 versus 20, they're like kind of mirror opposites of each other in a way. Yeah. So that leads me to believe, that next year might be a bit more challenging.
Coming into 2023, it was unanimous. Everybody, money managers, retail, economists,
CFOs,
recession, everyone, recession. Now, everyone, for the most part, agrees that we did it. We did the soft landing. Yeah. So you're right. Mirror images.
Slate inflation,
I want to ask you, we start, by the way, what did you answer the reporter? Because I think my answer was better. What did you say?
I either said delta or gamma.
Okay, so after all of this, I just said it's noise.
Yeah.
Oh, I should have said that.
What do you
know that
what's happening? What? The market was up.
I don't even take these
The market
calls
was up
anymore.
8 weeks in a row. It can't have a down day?
Yeah, but if you guys had someone call into your firm and just say, "Hey, what the hell happened today?" you would say it's noise.
Yeah.
But if you have somebody who's reading the Wall Street Journal to find out why the market reversed,
it's a Greek letter.
No, I'm so glad.
Really smart.
Dan, I'm so glad you said this because we started that conversation. You were about to say something about RSI.
Yeah.
And I wanted to ask you, when something is overbought, now all this depends on your time frame. To me, as not a day trader, that's bullish as hell. If there's an overwhelming amount of buyers versus sellers, I love that. Now, if I was a short-term trader, I might want to fade that enthusiasm, right? So it's just it's different time frames and people talking past each other.
Yeah. I mean, the time frame thing is really important because sometimes, I start out in the business with a short time frame and trying to find catalysts, whether they be fundamental inputs, whether they be events, a whole host of other technical things and everything. And part of the goal was just to have a pretty big toolbox, right? And if you learn how to kind of play the momentum and understand investor psychology and sentiment, that sort of thing, and there's ways to make money doing that, right? And then try to apply that skill set, though, to longer term investing. It's really hard. Try to apply speaking about the markets every day, right, to an investment process, you know what I mean, that's longer. I know I don't mean struggle with it, but I know that oftentimes when you're asked on the set of halftime report, right, when the market's something's going on, your one half of your brain is thinking about the sort of things that you talk to clients about every day. The other half is if you're a sociopath who's tuned in at 12:30 to watch CNBC because you care about what's going on in the markets, you care right now.
So I would say Josh doesn't struggle. Right? I would say Josh is the best in the world at
better than who?
towing that line
I love it. We
between
can end the show right now.
between contextualizing for investors, but also putting it in like, okay, this is happening today and this matters, but does it really matter?
Well, the question is not does it matter? The question is this an opportunity for people that don't care about this?
Yeah.
That's the way I frame
and almost
these
always
things.
the answer is no.
So I said this on our Fast Money call today at 12:30. So we played this little game in the beginning of the year. They asked us to do an acronym and come up with like 4 or 5, the initial letter of a stock, and then they grade you on the performance of that. It's it's goofy, but like the people love it or whatever. And mine this year was TSLQ. Okay, so it was TLT. It was Lyft, it was Snap, and it was QQQ. And I've been saying this for 2 years, okay?
Wait, explain this. What Tesla, Snap, Lyft, and QQQs? When did you say that? What is this?
So this was the first week of January, okay, on CNBC's Fast Money, and that was my acronym, okay? And so the point there—
For this past year.
For this past year.
How'd it go?
It went great. I'm winning, okay?
Look at you.
So my what I said of all of 2022, and I had people who worked for me, young people, I said the first $7,000 that you have that you can put in an IRA, that you didn't just go out and drink or whatever, you know what I mean?
Yeah.
Just dollar cost average, Qs and 2s. And I say 2s like for TLT, okay? And do it. And the whole idea is like if you just dollar cost average it. When you guys were in our pod in late, I think in the spring, I said when we started Q2 after a pretty rocky period, I was like, if you just dollar cost average the QQQ for every trading day from April, May and June, you're going to be in a good spot, especially if you have a long-term timer. So my only point is like, that's what everybody should be doing. Okay.
Coming up with like a shorthand for what they think the theme would be of the coming year.
Yeah, but just dollar cost average.
I don't hate that. You want to hear mine?
Yeah.
Okay.
Well, that's not what they want. Go ahead.
Mine is, no, it's important. JEWM.
Yeah.
Jeffrey Epstein was murdered.
Oh my God.
Think about it.
What the is happening?
Just think.
No,
Why?
Stop.
I know.
Dan, people want stock picks.
I know.
They want
I give them the picks. So what I said is do as I
What's
say.
wrong with you?
Do as I do as.
You really think he killed himself? Why randomly would he all of a sudden? He's been up against these allegations for 8 years.
All right.
One night, all of a sudden, he decided this is the night.
So
who
Dan,
did
you were
it?
saying?
Unlikely.
Who did it?
We know who did it.
Yeah.
I'll tell you.
Elaine.
Can't name names. So my only point was Qs and 2s, dollar cost average them, and then I thought
Snap? Great call, by the
Can
way.
I tell you why I said Snap and Lyft? Because I thought there would be strategic M&A for some of these.
Somebody
sorts of
should buy
names.
that
No,
Lyft thing.
no, I know.
agree.
Just Google should buy it just for the data. Like whatever.
Yeah.
And then Snap.
No, they should not. There's nothing there.
But that's fine. They will get bought ultimately, maybe for parts.
Private
you know what
equity.
I mean? Like, yeah, so like listen, like, but my point was that was the theme. And then the other part of this was the double entendre, TSLQ, was the
Tesla
inverse
Q.
Tesla. And I was dead right on the fundamentals of this company this year.
LOL. I was right on fundamentals. Get the out of
Hold
here.
on.
Of Tesla.
Right up.
Dead wrong on the stock performance. All that being said, okay, they have had 3 consecutive disappointments. Their earnings are going to be down 25% year over year. Their gross margins have gone from 25% to 18%. Okay, they're going to miss their delivery.
Dan, I
estimate.
love you,
Yeah.
but we know you don't get paid on fundamentals.
Okay, but what I do get paid on is having sound analysis. Okay, and I'm wrong a lot. And anybody in this market who tells you they're not wrong that much, they're full of shit. Okay, so here's the thing. Like, you have to have a fundamental grounding for any reason of you're going to buy or sell something, even if you're selling something after you've already bought it. And so, like, listen, you could get the fundamentals wrong and the stock price right.
Mm-hmm.
I think anybody who bought the stock right now, but it comes back to time horizons,
Right.
right? So margins have just contracted massively as competition has increased, and then all of a sudden maybe there's some issues in China. I'm not railing against this thing. I actually said on Fast Money the other day that there's a good chance that the fundamentals bottom out at some point early next year. All of what they got wrong is they thought there was going to be lots of price elasticity. They've been cutting prices for these cars. I know somebody who bought a Model Y for $67,000 a year ago. You can buy that same car for $47,000.
Is that how? Is
Yes,
that how much they've
been killing them.
And you've lost the subsidy along the way.
And let me tell you something. The more Trump goes up in the polls, how likely do you think there's going to be a $7,500 EV subsidy in Trump 2.0 administration? So there's lots of headwinds for this company. Here's the other thing. This stock went into the S&P 500 exactly 3 years ago at $232. It's trading at $255.
It's barely up.
The S&P is up 30%.
Yeah.
Okay. So to me, it is about time frames. Fundamentals do matter, especially if you're picking stocks, not if you're trading them. Not if you're trading 0 days to expiration option. Not if you're trading weeklies in Tesla.
On Tesla, on we'll move on after this, but on Tesla specifically, this is a way better stock to have bearish commentary on than actual bearish positions. You agree with that?
Yeah, because I lost a lot of money this year.
All right, I want to do this chart of the year because it ties into what we were saying before, how completely opposite 23 was from 22. Sam Rowe said this is his chart of the year. I love it. This is from UBS, Jonathan Golub, and it shows economists' forecasts for GDP growth in 2023, how they evolved over the last 2 years. And Sam says, quote, the GDP chart below highlights the improvement in economic growth that we've experienced over the course of 23. So I don't remember another year that looked like this.
So wait, for the listener, with the
in
chart,
in January of 2022,
it went straight down all year.
in January of 2022, people were looking for 2.5% growth for this year. It spent all of 22 collapsing basically to zero. And then in January of this year, it ratchets right back up to where it started.
Doesn't
from.
always work with the story, but that's the S&P 500.
that's-
That's a stock market chart.
Yeah. I mean,
It's
this is
consumer confidence. It's everything. So Fed Chair Powell told us last week at his presser that they're expecting 1.4% next year. So if the stock market went up this year 23%, the S&P 500, the NASDAQ went up 50% on just back to
50?
where the NASDAQ 100 is up 50%.
Yeah.
So think about that. So this V reversal, we're back to that kind of leveling off period from January of 2022. That happens to be the all-time high in the S&P 500 of 4,800. This is why I think next year is much harder. You know what I mean? Like,
Can I
so
show you
for
one
the
thing, though?
BTFD folks.
next chart, please. Let me remind you, sir.
Uh-oh.
The NASDAQ should not be up 50% this year in the face of this. Take a look. This is all of the rate hikes of this cycle. So this starts March of 22. You ready?
Yeah.
25 bips, 50 bips, 75 bips, 75 bips, 75 bips, 75, 4 in a row. 50, 25, 25, 25, 25. That is one hell of a rate hike cycle.
Yeah.
That all took place between March of 22 and July of 23. We've endured a lot, and stocks are still up as much as they are. So I can conclude one of two things. You tell me which one you think is closer to reality.
Mm-hmm.
Number one, stocks love rate hikes. No? We don't like that one? Okay. Here's another one. Number two, yes, there's more uncertainty going into this year, but one thing we know for sure, this is a very, very strong backdrop given all that we've endured, and probably the next move is some of this starts coming off. What are your thoughts?
Yeah. So, all right. So the coming off part is the most important part. So the dot plots in that last Fed meeting suggest 3 rate cuts next year, right? And so if I go back, I entered the
Is
market.
that what it's saying now? Three rate
and
cuts?
pulled forward to I think potentially March. Okay, so think about this. This is another chart that Sam Rowe could have come up with. He probably did. He's very thorough. Rate cuts were priced in. Like this year,
For
you know
this
what I
year,
mean? Like
yeah.
the prior year, you know what I mean? So like, for instance, the Fed doesn't have a clue. No one's got a clue. Everyone's chasing. That's the point. They were chasing on the way down. They're chasing on the way up. That V reversal in GDP expectations looks exactly like the S&P 500 from January 2022. It was at 4,800. It went down to 3,600.
They bottomed the
and
same
now
time.
it's back at 4,750.
Incredible.
So here's the one chart, and maybe I'll forward it to you guys. So I entered the markets in 1997. Okay, there's been rate hiking cycles into 2000. They paused. It was good for stocks for a bit. And then when they started cutting, it was lights out. Okay. And then they came off that 1% bound and they started raising, right? Into 2007. They paused. It was great for stocks until it wasn't. And still they started cutting. S&P gets cut in half again. Okay. So in my career, the rate hiking periods followed by a pause, good for stocks. Okay. When they start to cut, bad for stocks.
Oh, wait a minute.
Except for
Wait a minute.
2019, which you conveniently left out.
Well, 2019, the economy was already
Asterisk.
Hold on. The economy, first of all, it was gradual. In 2018, Josh, hold on a second. In 2018, the stock market dropped 20% in a straight line.
Twice.
From October, to December, and the Fed pivoted. Okay?
Yeah.
They pivoted. And then the stock market got back that in 2019. The yield curve inverted.
Three
The
rate cuts
210s
three rate cuts in 19.
in 19.
Yeah, in the first 2 quarters, three rate cuts.
Because they were redoing what they did
Dan,
in
the stock market went up
2018.
30% that year.
Yeah, and it went down. I mean, it was the only down year that we had since
those
2000.
were rate.
No, it didn't go down. In 2019, the Fed cut rates. The market did not fall. It went up 30%. And in fact, rallied into COVID, was continuing to rally in
all-time high
2020.
COVID,
So I'm
yes.
just saying that's an exception to that. I get the story. If the Fed's cutting, there's probably something really wrong. It's just not always. That would be my only caveat.
Yeah,
Just
well,
not always.
Okay, they land the plane and then they had to cut to zero. The next
but
time
that's
they had
not
the
a Fed.
opportunity
I
to do it.
mean, yes, they had to cut to zero
Yeah.
because it was COVID.
Here's what's undeniable: the market is optimistic. This is S&P 500 weekly win streaks. This is going to be the eighth
That looks
straight
super
week.
toppy.
Yeah.
So the market is obviously expecting good news to persist. Whether or not it does, obviously, remains to be seen.
So I used Google Bard for this. Fun fact: ChatGPT is pretty friggin' useless for what we do for a living.
100%.
ChatGPT 3.5 will not include anything that has to do with stock market, even most economic data. It's throttling the utilization, and it just won't include answers. So I used Bard for this, and what I basically did as a prompt is I said, please make a list of the 5 best up the most and 5 worst, meaning down the most, days of 2023 for the U.S. stock market. These dates must be from the year 2023 only. I highlighted all the stuff the computer fucked up, but it's a pretty decent list. So the best days of this year, we had a day in January, the first day of the year, January 3rd, might have been the second day. I'm not sure what was the, could it have been the second? I don't know. Up 3.09%. That was, and they'll give you the reason. Optimism for a new year and positive earnings reports. Good call. Yeah. April 5th, this is coming out of the bank crisis. Upbeat jobs data and a potential shift in the Fed's aggressive rate hike policy. July 26th, up 2.5%. And then December 5th, up, remember that day, up 2.5% on positive retail sales? That was the soft landing day. And then they say December 22nd, which is weird because today's the 21st. So I think they're pulling in the prior year. So they screwed that up, so I highlighted it. Then you do the worst days. I won't go through them all. They have the Russian invasion of Ukraine, which clearly did not happen in February of 2023. Happened in 22.
Yep.
And then they include the collapse of cryptocurrency as the 5th worst day, November 9th, 2023.
Nobody's perfect.
That was the year before. My point is, I asked for 10 things from Bard.
Yeah.
I asked for 10 things from ChatGPT.
Lot
They
was
gave me
wrong.
0.
Yeah.
They said, sorry, we can't do that. I asked for 10 very simple things from Bard. It got, on the surface, 3 of 10, very obviously wrong, and just made up a lie anyway to give me an answer. When you see stuff like that, you don't really get that concerned about this AI stuff really manifesting itself within the economy, taking white-collar jobs. I just don't think
I think there's 2 things that we want to break down. So that is a large language model that's being used for a consumer who's used to putting garbage in and getting garbage out at Google and the like, or Bing, or whatever your service is. I get concerned about the folks who are infinitely smarter. They're thinking about generative AI models away from large language, consumer-facing sort of things, how to integrate that technology to advance the processes that they are using in their products and services. You know what I mean? Like, that's what the smart guys are working on, not on chatbots.
The,
you know what I mean?
The layer, though, that's they're building a layer on top of large language models.
But I think one of the stories that you're going to hear, and one of the reasons why I think probably Alphabet's going to play catch up to the Microsoft OpenAI narrative in 2024, is that they bookended this year by a really bad Bard introduction in January or February. I think it was the first week of February.
With a great Genesis launch.
And then this Gemini, launch that they had just a couple weeks ago wasn't particularly great, but the stock just made a new 52-week high. The stock trades at a much more favorable valuation that, to Microsoft, for instance. Now, Microsoft obviously doesn't own OpenAI for all intents and purposes, and Google has said that they're an AI-first company for 6 or 7 years. I think Sundar Pichai will and the folks there, I think they'll probably get some things right in 2024.
Did you notice yesterday when the whole market got killed, Alphabet was green?
Yeah,
and it was on an AI advertising headline.
Yeah,
they're putting their whole digital ad business into the AI stuff.
Yeah.
I think you'd be right on that.
It's cheap enough.
I'm long the stock. I'm not long Microsoft.
It's cheap enough to make a relative bet if you think even that some of this stuff is like kind of long in the tooth. I want to make one other comment. I know it's your show. I just want to go back to 2019 for a second because I think this is really important. Okay, so the Fed started coming off their zero interest rate policy in late 2015. Okay, Fed Chair Powell is actually appointed by Trump in 2017, and he goes on this autopilot raising 25 basis points every other quarter. Trump hates it, okay, right? They also enacted this tax cut, right? So they all of a sudden, they supercharged the economy, right, with this tax cut. Things were getting a little overheated. That gave Powell the confidence to keep raising. But it wasn't until 2018 we had this global growth scare late in the year. And it was China, it was emerging markets, and the stock market started getting killed. And that's why they pivoted. That's why they cut it. This is the most important part about this, why I think about next year in 2024, why 2018 and 19 wasn't a good analog. We had, I think it was 2.2% GDP growth in 2017, it got to 2.9% in 2018, powered by the tax cuts. Okay, and then it fell back to 2.3% in 2019. The 210 inverted. They started cutting because of weakness in the economy, and this is really important. I saw you on Scott's show right after the Fed presser the other day. You came on after Jeffrey Gundlach. Jeffrey Gundlach thinks that when the Fed starts to cut, they're going to have to cut aggressively next year because of weakness. There's this whole cobble of folks
What did he say? Like if they cut by 25 basis points, they're going to have to cut 2% or something?
Yes. And so the one point why I think it's great that you bring that up, okay, 2019, but if things do start to weaken, and again, I'm not an economist. I don't know, okay? The last time I was on here, I think the headline, the title was Dan Nathan predicts recession. Okay, you nailed that one. Okay, I predicted it. It didn't happen. I think I went back and listened to that pod. It was a great pod, by the way. And we didn't say
you're a fan favorite here.
Oh, well, thank you. Okay. I appreciate it. I love being here. So that was why I wanted to make that point. So there's a lot of folks who think that the Fed, when he said we are going to have to start cutting before we get to our 2% inflation target, a lot of people think that there's bubbles or there's issues bubbling up, maybe in private credit. Maybe there's some geopolitical thing or whatever. So that's the only point I want to make is that the markets are pricing now a soft landing. That's what they're pricing.
No doubt.
You know what I mean?
I totally agree.
So that's all I just want to make that point.
100% agree with you.
Okay.
Ed Yardeni, a dozen reasons to be bullish in 2024.
Only a dozen?
Is 12 not enough?
I like Ed. He does great work and he's generally optimistic. Is that fair? Like you guys have followed him for a very long time.
Generally optimistic, and that's actually been the right posture.
Yeah.
At least in recent memory. Which do you think are the most likely of these, or which are the most suspect? Ready?
Yeah.
I'm not going to read the whole thing. I'll just give you the headlines. Interest rates are back to normal. So the normalization theory implies the Fed might not lower interest rates next year as much as widely expected, but that's actually a good thing, because it means the economy doesn't require them to ease at all. I mean, could that be
that would be a
reemergence
reemergence in inflation? And why would inflation reemerge? Either the economy is really strong.
So if there's no inflation reemerging, then we are getting cuts, period?
100%.
Absolutely.
Okay. Because then what happens is, think about this. If inflation gets to their target and they have kept rates where they are, then it's really restrictive. And then it runs the risk that you actually have a material slowdown. And they do not want to be behind the curve on that. Because then they've got transitory wrong in 2021, right? And then they were folks
too tight and they okay, I'm with you. Okay. Consumers have purchasing power. How tired are you hearing this?
Yeah.
40% of small business owners reported they have job openings.
Wait, hang on. How is this bullish? How is he saying? How is this bullish? Many consumers may soon run out of their excess saving, as the economy naysayers are saying.
Nevertheless, that's how. No. Most of them are likely to continue to consume as long as job security remains high.
Okay, I agree with that.
We know that's true.
Yeah, of course.
Well, talk to anybody. Okay, so one of the things I think is really interesting, I think that the jobs market is kind of being bifurcated right now. So talk to anybody who does a knowledge job, okay? So if you were one of the people who benefited from all these big tech platform companies in 2020 and 2021 hiring like drunken sailors and bidding up things and this or whatever, and you've just lost your job over the last year, it's been really hard to find another really good job at one of these.
Truck driver can get hired in a second. You're right. You're right. So if you're an associate editor at Condé Nast for $300,000 a year, you're not getting another version of that job anywhere. I'm 100% with you on that. Are you following Affirm and the news flow now about people are buying groceries at Walmart with buy now, pay later?
Yeah.
They're now taking buy now, pay later at the register.
And
That's a story.
Why are they doing it? Because they've maxed out their credit cards. So think about that. It's really dangerous, okay? And it's really scary. And so Walmart just did this deal with Affirm, and hopefully they're going to put, like, maybe it's going to be large, like the sort of stuff if you...
Dude, if you need to pay later for groceries, you're not in good shape.
But maybe it's not groceries. Maybe they're allowing you to buy a flat screen TV or a computer. Like they have, like, like hard goods. You know what I mean? I know 50% of the stuff at Walmart is groceries. Let's hope that's the case, because that would mean that the consumer, the lower end consumer, is really tapped because they're out of credit, and this is one of the last places to do it.
Or it's just a smarter way. Or it's just a better alternative than a 28% APR MasterCard swipe. It's just smarter. That's possible too?
Yeah, I do think it's interesting that this is a stock Affirm that was priced to go out of business. It was down 95% from its all-time highs about a year ago.
The stock is incredible.
Yeah, and now it's up. It's gone from 5 to 50 or something like that in a straight line.
I
this
saw
year.
something about the short sellers on Twitter. Hate this guy, Max Levchin. What's his name?
Yeah, Levchin. He was a PayPal founder.
So they hate for whatever reason. He's like the new Elon. The more the stock goes up, yeah, they're getting really mad that the stock is working. I don't know why though. I haven't read.
So this is really interesting. This was in the New York Times, I think, yesterday. Okay. The fact it was in the New York Times. It wasn't in Barron's. It wasn't in the Wall Street Journal. It wasn't on Bloomberg. It wasn't on CNBC.com. Americans may be taking on too much pay later phantom debt. And it was talking about this in the New York Times. Okay. So this is one of the top stories that I saw on the front page of the New York Times.
Do we have numbers?
Geez, no one said there's going to be any math here. Estimates the size of this market vary widely. Spending through pay later options was about $46 billion this year. That is a small compared to more than $3 trillion that Americans had on their credit cards last year. Okay, but it's growing, and I think the more awareness it is, the more people are going to take up on it, and especially with rates higher. I know that the 10-year has gone from 5 to 3.9%. The 30-year mortgage has gone from 8 to 6.9% or whatever. Those credit card rates, they're not moving.
So the New York Times reader is not going to read that and say, I should start doing buy now, pay later. You know when we're in trouble? When like Kevin O'Leary has commercials for his own like buy now, Kev later. Like, you know what I mean? That's when you know it'll have gone too far. I don't give a f. Don't edit that shit out. Leave that in.
Will that be on the blockchain?
Dude,
and purchase through gold?
I'm this close to just going all the way. All right. Households are wealthy and liquid. $151 trillion in net worth in households. This is an undeniable bullish. Now, it's not spread out.
Yeah.
We know it's haves and have-nots.
Yeah,
Nobody would deny.
But there's $40 billion in pay later debt.
Yeah, $40 billion. So, I mean, you have to admit that's not a bad setup.
No.
That's not 2007.
What else?
All right. Demand for labor is strong. Okay, self-evident. That could change. It just hasn't yet. We all stipulate? Okay. Yeah. Onshoring boom is boosting capital spending. This is the argument for buying the cats and the deers and the,
Caterpillar all-time high.
Yeah, but by the way, Deere was
do you believe in this story or not really?
Deere was trading at a 52-week low a month and a half ago.
The onshoring boom and the federal government's increased spending on public infrastructure are boosting new orders for construction machinery, which is up 30.5% over the 24 months ending October. True story.
Yeah.
True story. Okay. Housing is all set for a recovery. Do you believe this?
Yes.
I think I do. Just purely on the demand side.
Only happens if unemployment doesn't go higher.
Wait, but mortgage rates are dropping.
They're still 6.9% for a 30-year fixed.
Okay. All right, question mark. Corporate cash flow is at a record high. $3.4 trillion during Q3 2023. SAR. But still, this is real.
Yeah, so the corporate stuff is interesting to me. These companies, especially the ones with lots of cash, they're finally earning a return on it. They've been cutting costs, good for margins. Input costs hopefully are coming down, like all that. So the dollar coming down, like you could make a very good argument that corporate profits are, basically we had the profit recession, the stock market in 2022
big time
discounted that. In 2023, the year that actually profits are expected to be flat. I think FactSet has S&P earnings in 2023 like up less than 1%, but consensus is calling for up 11% next year. So let's say we end up somewhere in the high single digits, like you tell me, the stock market feels a little bit expensive at 19.5 times.
Yeah, are we pricing that in that 11% in right now?
Yeah. And one of the things, and I think you guys are probably aware of this, like in the lows in October of 2022, X the Mag 7 or the top 10 names or whatever, like most of the S&P was trading at like 13 or 14 times earnings. It was trading at a trough multiple, you know what I mean? And so like that's important. But I guess, a lot of folks, and this is the thing, I have a lot of issues with this, okay? So a lot of people will say, well, over the last 50 years, when we come out of a bear market, the prior leadership is not going to lead again. I don't know how. If you just look at the weightings of these names, I don't know how those top 10 stocks, most of them can't continue to be the leaders because energy is low single digits. Financials is
just
big
too small to matter.
They're too small to matter.
Yeah, you're right.
And then you think about these companies, they are moving into every part. They're just so disruptive. You know what I mean? Think about an Amazon. They just move into whatever they want. You know what I mean? Like, so to me, again, I think they have to lead. I'm not saying all of those stocks are going to be the top 10 stocks 5 or 10 years from now, but at least half of them are going to be.
So can I tell you, Ken Langone is on record saying Eli Lilly is probably going to become the world's first $1 trillion drug company. That's a non-FANG. NVIDIA was not in this group of stocks until 2 years ago. We can stipulate that.
Yep.
So there is some leadership change. It's just not like Apple and Microsoft coming down.
Netflix got shadow banned from the
All right, let's keep going. Number 8, inflation is turning out to be transitory. Open question, and people would probably say transitory after 2 years.
Yeah, it's cumulative. We just do the math, right? So, 3% this year is still a lot. But if you're
still a lot relative
it's
to the last
a dumb
15
phrase.
years.
Inflation wasn't transitory. Prices have stopped rising.
The high-tech revolution is boosting productivity. Not a lot of people talking about this, but if all this AI shit turns out to be meaningful to the real economy this year, productivity will improve.
Yeah, I would say this, though, that if you think about this, I know I see everybody in your office here at Ritholtz Wealth Management. A lot of businesses still have hybrid work things that is massively unproductive. I mean, so the 3 days that they're in their office, they could probably get everything done that they're doing their 5 days because they're not doing anything on Mondays and Fridays when they're not in the office. So I think we have a huge productivity issue as far as
maybe your employees.
No,
speak for yourself.
No,
our employees are working their ass off.
No.
My people grind.
I just said they're all here, but what I'm
They're
saying,
not all here.
Okay,
half of them remote.
Okay, but maybe you guys are a customer-facing sort of business, okay, and you're talking to a lot of people. I mean, there's a lot of processes that people are just like even when they're in their office, they're made to look busy. I think 20-something-year-olds are really lazy.
I agree that there's a lot of bullshit going on.
So I think that just naturally, I think these companies are going to continue to cull. Okay, I think that it was a land grab in 2021, and it was easy to hire people that were remote. You didn't have to do all this stuff on premise and all that sort of stuff. I think they're going to continue to call a lot of these people.
All right, my last ones. Leading indicators are mostly misleading. Well, you could take LEI and throw it in the garbage. I think at this point, the recession signals are just misfiring to the point where it's not usable.
Yeah.
So that's my opinion.
All right. So can I turn this whole thing upside down for a second?
Well, let me give you the last ones.
Oh.
The rest of the world's challenges should remain contained. I would
contained
say.
Is a keyword.
Come on.
Contained.
Come on.
Yeah.
Roaring 2020s will broaden the bull market. So I guess this is a call on more participation. I don't know. All right.
Callie Cox had a great chart showing that this is a very unusual bull market that we're living through. 71% of S&P 500 constituents are underperforming the benchmark this year. That is the highest it's been this century. Mm-hmm. I think it's probably the highest ever. And when she looked at it, she broke it down sector by sector. The only sector that is outperforming, where the majority of components are outperforming the S&P, I mean, this is not news to anyone, it's tech. So 93% of utilities are underperforming, 90% of REITs, 97% of consumer staples, 91% of energy. The only game in town, the only stocks that are outperforming themselves because the size disparity, it's tech stocks. We know that. However, I was looking yesterday when all the Dow was going down because all of this nonsense noise. These are the companies within 3% of their all-time high. Costco, Broadcom, Arista Networks, MasterCard, NVIDIA, Marriott, Hilton, Waste Management, Lululemon. These are just S&P companies, by the way. Lam Research, General Dynamics, Ameriprise, Booking Holdings, Visa, Apple, Phillips 66, Ross Stores, Chipotle, Caterpillar, ServiceNow, United Rentals, Pulte Group, McDonald's, Microsoft. These are all of the companies within 3%, not of their 52-week high, of their all-time high.
Yeah.
All-time high. So all of the data about companies underperforming the S&P, it's because these companies are so big, the winning ones. Apple is up 50% this year. It doesn't mean the rest of the market is falling apart. If anything, the market is telling you that things are pretty good.
And those are a lot of sectors
I kind of
represented
take
there.
the opposite side of that because, so
I find that hard to believe. Go ahead.
No, but so the RSP, the equal weight S&P, is still down 5% from its all-time highs. The S&P is within earshot, like a 1%. It's interesting that you mentioned Microsoft and Apple. They make up 14.5% of the S&P 500. Two stocks, 14.5%. They are at their all-time highs. They're $6 trillion in market cap.
You don't say, but they're like 20 businesses combined. But back to you.
Well, I mean, at the end of the day, Google, Amazon, Meta, Netflix, Tesla, these guys they're all still well below. So you could look at it both ways. You could say there is fuel in the tank. You know what I mean? If there's reasons to buy those stocks, and some of them are very cheap, Google and Meta, and still that sort of thing. But you could also say they're basically underperforming the major indices on a relative basis versus the all-time high. I mean, there's different ways to look at it. I was actually looking at a lot of what Callie was looking at too, and I was quoting this a couple times over the last few weeks. On the day of the Fed meeting, I looked at the 500 S&P 500 stocks. There was only 210 of them that were down on the year that day. Okay, so this was 2 weeks ago, or December 13th or something like that. There was 140 of them. To your point, I think that gets you to the 71% that were underperforming the S&P 500's performance. So there was a lot of stocks in the largest index in our country that were trading really poorly. You could say it's about. I don't know. I don't know. I mean, like, to me, they should be reflective of their earnings potential and what's gone on. But a lot of companies, a lot of C-level executives, they're not bullish. Like, they're being cautiously optimistic when they're being optimistic, right? Have you guys look at a lot of transcripts? You listen
but
to a lot
if
of
you
earnings
look at
reports?
the percentage of new highs, it's building in equal weight. In Russell, it's
but the Russell was at
catching
a
up.
2-year low, Josh, 2 weeks ago. Or
Right,
a month and a half ago, excuse me. Okay, like a month and a half ago. It looked like death, and it's still 20% from its all-time highs in 2021. If the Russell can't break out of this 18-month range.
You don't think it's bullish, though, for more and more of the components within the Russell to start hitting 52-week highs? Like,
no, it is bullish. Of
it
course
needs to improve, obviously.
I think that the market's going to overheat next year. I think there's like a real possibility.
Like right out of the gate.
Mike's risk is that things get too good too fast.
I think that there's a non-0% chance that mortgage rates continue to fall with inflation. Mm-hmm. The housing market just explodes. Stocks go nuts. The IPO window opens up, and we overheat next year, and the Fed has to hike.
IPO is really interesting. So you guys tell me, we have the NASDAQ that's up 50% on the year. We had Klaviyo, we had Instacart, we had ARM. I mean, like, if you can't bring an IPO in a market like this, when the hell are you going to do it?
Next year. 2024 is the year.
Well, think about this. How many tech IPOs have actually performed particularly well since 2017?
No appetite.
It's amazing. You know what I mean? Like,
Yeah.
so it's interesting to me. So people ask, when's Stripe going public or this or whatever? You know what I mean? I don't know. Like, if they don't need the cash and they have other ways to kind of get their VCs and their employees, you know what I mean, kind of liquid, maybe that's a new trend. Maybe like private for longer.
So here's what happened this year. Apple up 50%.
Yep.
Added, we have a few charts, we're going to talk about Apple, added almost $1 trillion in market cap.
Yep.
They're not growing their revenue. What happened was the stock was trading at 21 times earnings to start the year. It's trading at 31 times earnings at the end of the year.
Yeah.
So this is Barron's cover story, which they put out today. And the gist of it is, the title is Apple needs new growth to justify its soaring stock. It won't be easy. There is no growth story at Apple. Services are growing, but hardware is slowing faster. Revenue growth is negative multiple quarters. They haven't had a big product release since 2016 with the AirPods. But the services growth is just more profitable than hardware. Mm-hmm. So the stock has been bid, and they are just buying back shares hand over fist. And whatever they're not buying, Berkshire Hathaway is. And that's how you have a stock go from 20 to 30 times earnings with no growth in the course of this year, which is what's happened. So Savitz at Barron's is saying, like, okay, but seriously, now what?
Yeah. So great conversation, to be honest with you. So $1 trillion in market cap for a company whose margins are flat, their earnings are flat, mid-single digits
down.
revenue growth, lots of competition. China is a huge potential problem for them. Shadow banning of their, of Apple iPhones, by government workers, which could extend. Reshoring is expensive for them. It should kind of be a hit on margins. Their phones are evolutionary. Listen, I do love their products, okay, but this is an iPhone 12. We're on 15, okay? And it works great. You know what I mean? So, just saying, so I agree with that. The services thing, every time Epic wins a Google thing or this and that, whatever, that is going to be a pressure on services and their take rate on that, right? So if that's the story why we've got 10 turns from 20 to 30 times or whatever with flat. So to me, Apple seems challenges, but I'm looking at this and I love this spreadsheet. It's on the Apple Investor Relations. Since 2012, when Tim Cook came in and took over for Steve Jobs, they instituted the buyback and the dividend. They have, you ready for this? They have bought back $630 billion worth of stock.
It's incredible.
They have returned in dividends $150 billion. Okay, so do that math. That's 812. How many companies in the S&P 500 have an $800 billion market cap? 10.
Yeah.
Okay. Like it's truly astounding. Okay. So it's an asset class in among themselves. And it brings me back to what you're talking about. That
It's a true
71%.
unicorn. It's a true unicorn.
So I think passive investing, and you guys know this better than me, I think it's changed the game. You could have hundreds of stocks down on the year in the S&P 500 and the S&P is up 23% because, and I also heard this, who's this guy, Felix Zoloff? I saw him
around forever.
He's been bearish for 30 years.
Okay.
Pay no mind.
Like me. So it's my dad.
Brilliant guy, always negative.
No, but there was just one stat that he said. So 30% of passive investing money goes into the Mag 7, okay? So we just do that math. We know that they're 30%. Globally, okay, the U.S. is 70% of global equity indexing, okay? So think about all that money that's indexed. It's going into Apple and Amazon and Google and, you know what I mean? Like all that sort of stuff. So we're really hitting on something right now that none of us in our careers have ever faced. Like people have said, well, we've always had this concentration of some of the big names. I think that's what could be different. Like, have you ever seen the biggest stock in 1980, 90, 20, and it shows how like they've changed over time? I think there's a really good chance there's 5 or 6 of the top 10 stocks right now, 10 years from now are going to be in the
I
top
agree with
10.
you. It's not going to be.
Michael thinks that too.
It's not going to be because of index funds, though. It's just index funds are not creating Apple's dynamism.
These aren't shitty businesses.
Hold on, listen.
These are incredible businesses.
A few things. Number one, you're right. Index funds are obviously, the flows are undeniably massive. The index percent of overall trading activity on a daily basis is in the single digits. Active traders are still setting prices, number one. Number two, index fund flows did not stop in 2022, and Amazon lost 55%.
Yeah.
Google lost 50%. This is a fucking non-story.
Meta down 70.
It's not, the index fund flows are not keeping these stocks
what
high.
I think is more important though is that Elon Musk is the richest man in the world. He's the CEO of 5 really important companies. Let's say 3 really important companies: Sundar Pichai, Satya Nadella, Tim Cook. They are more powerful and more influential than most heads of state that we have in our country. I think that's what's changing. So take all these sci-fi dystopian things like Blade Runner and stuff like that. You know what I mean? The leaders of those like really effed up worlds going forward are not the elected officials. They're the people who run these gazillion dollar companies.
Who thought that Amazon was going to own Whole Foods and that these companies were going to dominate streaming and Hollywood and sports?
I see your Sundar Pichai and your Tim Cook, who honestly seems like both of those guys seem like lambs.
Yeah.
I raise you J. Pierpont Morgan.
They're killers.
And I'll give you U.S. Steel.
You think the trust busters could take these guys down? You think the trust busters? We've been talking about. We don't even blink an eye anymore when there's some regulatory. FTC is suing that.
Standard Oil fought trust busting for like 20 years, and eventually trust busting won. He was like 90 years old at the time. This is not. These things have happened in the past.
Yeah. I think the intelligent.
They got busted up.
Dan, the intelligent.
AT&T.
The intelligent, air quote, thing to say is look at history. The top 10 stocks, there's always turnover. What you're telling me is different this time? Yeah, a little bit. Are these companies Are they impenetrable
Think
forever?
about the top 10 of when you and I started our careers. It's Exxon, it's
It's banks,
IBM.
it's banks and energy companies and IBM
Right.
and Walmart.
There's no analog to what these companies, and you said it. Amazon doesn't obey the rules. They're going to get into pharmacy now.
Yeah.
They just do whatever
But
they want.
they're absolute monopolies.
But you could make the case that GE was a conglomerate. IBM was not selling groceries, right? So when you had that top 10, they looked pretty infallible. They ended up all being fallible.
Yeah.
And I think Enron might have been on that list at one point.
Yeah.
Okay.
And all these companies,
That's not
Microsoft,
this.
Amazon, Google, they power the internet with their cloud computing. Like their tentacles just keep spreading wider and wider and wider. There's no end in sight.
We're in agreement on that. One thing, and I want to make this point because we just mentioned, China with Apple. I think the data, economic data in China, and I think the deflationary readings that they're having, I think a huge risk that people are not focused on, and again, not an economist, and this is not a recommendation to buy or sell anything on this. I think that there is huge potential for them to export that deflation. What if this whole race to 2% in inflation ends up being really deflationary, right? And so think back before the pandemic, people were really worried. The Fed was dying to get inflation up to 2%,
Yeah,
right?
couldn't do it.
Right. So
Right.
so what I worry is that, and think about what's gone on over there. I mean, their stock market's in shambles. Look at Shanghai's very near 52-week lows. The FXI, which is heavy, those big tech leaders, banks, and some industrials, they trade horribly. They're trying to support that economy. It's not working. Going back to that conversation about 2018, it was a global growth scare about China. Back to 15 and 16. You remember all that volatility that we had in the summers into the Q1 of 16? All about China. Think about their reluctance potentially if China is, or if Apple is moving away, right, to India and some of these other manufacturing areas, if they're reorienting these supply chains, then the Chinese may just say, screw them. You know what I mean? Absolutely screw them. You know what I mean?
What percent of Apple's revenue
20%.
is China?
A lot.
Yeah, it's important.
It's important.
Dan, it's the last episode of the year. Higher or lower next year?
Interesting. I was really wrong. I thought the potential that we'd have a really bad first half this year and end up, probably other side of 5% either way. I think we're lower next year because I think of the volatility that we talked about as far as 2022 to 2023. I know election years are generally pretty good. I think at some point we'll probably be down 10% next year.
Well, yes, of course.
Does that make sense?
We will have a 10% drawdown next
because
year.
on average, there's
of course.
always a 10% or something like that. But
20% higher.
you think 20% higher?
Yeah,
What do you think?
I do.
20% higher?
I do.
So you think this is like 95?
I don't know what
to
I think,
2000.
so I don't know why
I
I'm asking you
don't.
that way.
I think that. Listen,
I don't really have that strong of a
I'm just
feeling.
going to go on a limb and say that I will probably be wrong because predictions are impossible. But I don't know what's going to knock the economy off track, and I think there's a possibility that just the market overheats and just people go nuts again.
Well, that brings me to China. I mean, I just think that a global slowdown with like geopolitical hotspots, like inflation that doesn't come down as quick. I think inflation going higher would really screw up a lot of narratives.
I think that's actually, I don't think it's the biggest risk, but I do think it's the risk that could play the most havoc with the market.
Can't you see?
If the Fed has to restart a hiking cycle, we're going to lose huge multiple on the S&P.
Well, Michael, what if January 31st, when the Fed meets again, what if there are it's probably too soon from December 13th, but what if there are heightened inflationary fears or something like that, and then the Fed basically uses one word like any that sparked that rally, or you know what I mean, and takes that away and then says something a bit more restrictive or something. What do you think the S&P is going to do? It's going to drop 2% in a straight line.
The market's not going to go 20% in the straight line next year. I mean, obviously.
No, I agree.
But can't you picture the headline that we see some scary stuff around the election season and Dow is up 1,100 points? Can't you see a dumb headline?
That would be so on
Dow
brand.
hits record high as chaos breaks, God forbid, but you know what I mean.
Listen, I'd buy stocks with two hands if you told me that the market's going to be up 20% heading into the November election and we're going to have a status quo in what goes on in Washington. Literally, you know what I mean? But
Dow soars as rebels encircle U.S. Capitol.
Shit.
You know these are the headlines. All right, did you have fun on the show today?
I love this show. I wanted to give a quick shout out because a couple weeks ago you guys had Morgan Hounsell on. Okay. And I know he's a longtime friend of both of yours. And you guys did not talk a lot about his book. But I heard him on Preet Bharara's podcast, Stay Tuned, I think last week or something. And I read the book immediately after.
We listen to Preet Bharara's podcast.
Where are you going with this?
Okay.
That book was awesome.
Awesome.
Same as ever?
That's where I was
Loved
going.
it. Loved
I loved it. I
Loved
loved that it was just digestible. I loved all the narratives.
best.
Is he like he is?
He's incredible.
He literally the research that went into all of those different stories to make those cases.
He
was
collects
amazing.
them and he writes he writes so beautifully around these great anecdotes.
Yeah.
That's what I was saying. It's not just the knowledge, and of course, it's the way that he delivers it to the readers.
It's very
so
it's
digestible.
very straightforward,
Yeah.
and he doesn't use 3 adjectives in a sentence where one will suffice the way I do.
Yeah.
And he also doesn't shift into the first person, which is another thing I do too much.
Yeah.
Like he will start a paragraph from one perspective and finish that paragraph in that same perspective.
He's a beautiful man. I love him. Wait, before we finish, what's going on with Paramount? Just get us up to speed real quick.
I don't know. You gotta
So
take,
on
you gotta
Tuesday,
take on the
Dan,
streamers.
wait, hold on,
it.
Dan. On Tuesday, Josh is like talking about how Paramount's about. I'm like, there's no fucking buyers for this shit. What are you talking about?
Good call, Michael.
24 hours later, Warner. Well, but it's in fairness, it's merging.
really-
It's
all right.
merging. It's not buying.
I am really following this story because I find it fascinating that we broke the cable bundle and now we're going to put it back together in just a new configuration. I think the most fascinating part of this pertains to the stock market in that what will ultimately happen is Amazon, Apple, and Alphabet will own all the entertainment assets. And Netflix.
By the way, if they merge, that you don't win. Merging is not buying.
What?
If Paramount and
I think
Warner
it-
Brothers merge,
I
it's
think
not
it's
close
good.
enough.
I think it's
not,
good.
not really.
One of them will end up with the majority of the company. That's the buyer.
So I
It's a
just,
merger
you know,
of two unequals.
I've been saying the exact same thing, not specifically about these two things. That all these things will be rebundled, and then their handlers are going to be Apple TV or this and that, whatever. And there's going to be a handful of different. It's not going to be Spectrum or Comcast or this and that, whatever. So I think that makes perfect sense. That's going to happen. These businesses run as like a standalone.
Dude, Apple and Amazon are taking over Hollywood.
I know.
Was that on your bingo card 5 years ago?
No, and it's not. Forget Hollywood. Hollywood is not even the
Sports.
prize.
Sports.
Well,
Pro sports.
So what Netflix is doing with some of these live sports, that's the thing to
Where
watch.
do you think this
in
is going?
streaming
Where do you think this
2024.
ends?
They're just
All right,
practicing.
the most genius thing that I saw this year on Friday, okay, this is Black Friday. NFL has never had a game on Black Friday, right? They had a game
Amazon.
that they gave for free, and they kept on doing all these celebrity drops of products, all these QR codes. That's the future.
100%.
I mean, that was
100%.
killer. I mean,
100%.
I didn't enjoy it. I don't give a shit. But they're like, don't go to the mall. Don't go to the department store. Stay here. Watch this football
the
game.
QR code.
Scan the QR code.
Dan, this is why I've been bearish Disney. People are like, Amazon will just buy or Apple will just buy ESPN. They don't want all of Disney, but they'll just buy ESPN because it's like the #1 name brand in sports. It's like, all right, but they have literally shrinking subscribers from the cable bundle breaking up on one end. On the other end, they literally are going to have to bid against Netflix for sports. They have to bid against bottomless pockets.
Yeah.
Like, so you're losing your revenue and your costs are going up. That's why no one's bought
I
ESPN
can't
yet.
wait to find out where Disney is in 12 months. I'm a shareholder, unfortunately. But because on the one hand, you have this push and pull of whatever. Which could the news possibly be worse for Disney? Could the news possibly be worse?
Well, the cable bundle thing is the thing. Most people are paying for all that shit, and they don't even.
What I
want to
know
for
is
it, and the
what
more
is
they cut the
Nelson
cord-
Peltz behind closed doors telling Bob Iger he wants? It's not even clear what the solution is. It's not like Peltz has made this public case of how to fix it. He has Perlmutter's shares or whatever the guy's name is, the
His
old
mother was a
psychopath.
mutter.
So he's got access to enough votes. He'll get on the board. But what is the answer? I don't even know. So I find this a fascinating time in media. All right, we're going to wrap up from here, but we're going to do favorites before we get out of here. Michael, you have a favorite today. Start us off.
Aaron Stanhope and the pseudonymous Jesse Livermore wrote, I actually didn't finish. This is long. I'm 40% of the way through this post. Climbing the maturity wall of worry. And they break down, so we've shown charts like how much debt is fixed for the S&P, how much more exposed the Russell 2000 is. So they get granular on which sectors are most exposed to higher interest rates. This was written, obviously, when higher for longer was consensus.
Yeah.
But just an incredible piece of research.
What do they conclude?
I'm only 40% of the way through. It's
Okay.
like 40,000
So
words.
where do you find this? You go to Canvas,
No, you go
Has
to
a
our
blog?
show notes. That's where you find
go
it.
to our show notes.
Come on now.
Who didn't think about that? Dan, you got a favorite for us?
I thought we were doing that with the Morgan Housel thing.
You want to use that as yours?
Yeah.
Shout out to Morgan.
Yeah. I just read it this week. I thought it was awesome.
I got some new music. Willie Nelson's 90th birthday took place at the Hollywood Bowl in April. They just put it out as an album on. I'm sure it's on Apple too. I saw it on Spotify. This is like, these are the final days, right?
Yeah.
For these people. Like Charlie Munger just passed. I think we need to appreciate Willie more, just as like an institution, and just someone who never who never changed and was consistently good for decades and decades and decades. And it's a pretty good listen, pretty good record.
Okay.
So I thought I'd hit you guys with that. All right, that's all I have. As our final show of the year, Duncan, are there any other announcements that we should be making?
Well, I just wanted to say I think we found our number one listener from people that wrote in from Spotify Wrapped. We have Nathan with 0.01%, and he has 11,884 minutes of listening this year.
Holy
So,
cow.
That was me.
So thanks,
Nathan.
thanks, Nathan.
Nathan, thank you so much. Merry Christmas, Happy Hanukkah, Happy New Year. We appreciate you. Let me just end the show for the year by saying how much I appreciate, and Michael and we all appreciate, the listeners. You guys are rocking with us all year. You guys are giving us amazing feedback, telling us everything that you like, what we're doing, sometimes telling us what you don't like, and we're reading it. We're listening to you. Thank you guys so much for tuning in every week. Now, twice a week we do this show. And I want to personally say thank you to all the people behind the scenes who make the show possible. So we'll start with our research associate, Sean, who's not here today. Rob Passarello, who joined us this year to manage the business end of the compound. Nicole, who is heading so many things. She's booking shows. She's running shows. She's the head of audience engagement. She's on our social channels. She's responding to all your comments, and she does it with a gigantic smile on her face every day. So shout out to Nicole. I want to highlight the work that John has been doing all year. John knows what charts we want before we even know we want them on screen. He's intuiting and making the show so high quality, whether it's YouTube or it's audio, whatever. John, you're the best. And of course, can't leave out Duncan. Duncan's wearing a Dunder Mifflin Christmas sweater today. Duncan is the co-star of Ask the Compound with Ben on YouTube. For those of you who aren't watching that show yet, you could see Duncan in action. But Duncan is really our creative director and has a hand in everything that we put out, and has just been so instrumental in improving the quality of what we do and insisting on quality. Even when I beg him to cut corners, he will not do it. And it's the only friction that he and I have is I want faster, and he says no. The audience demands better, and he's always right. So shout out to Duncan. And we'll give Dan a shout out too. Newest member of the team. Hey, Dan, how are you? We're giving you a shout out right now. I know you just joined. You haven't done a lot. You've done a lot of little things. And in 2024, you're going to become instrumental to
Big
this.
things have small beginnings.
That's right. So we're so happy to have you here. Thank you for joining the team. All right, that's it from me. Guys, thanks for listening. Hope you have the best holidays. Hope you have the best new year. And we will see you all in 2024. Thank you.